Hi, today I'll be talking to you about adjusting entries. Under the accrual basis, revenue is recorded when earned and expenses are recorded when incurred. The process of recording and adjusting entries occurs at the end of the accounting period. Adjusting entries does not include the cash account, as the exchange of the cash does not always coincide with the earning of a revenue or an incurrence of an expense. There are 4 scenarios which display that adjusting entries are necessary: deferred revenue, accrued revenue, deferred expense, and accrued expense. Companies receive cash before they earn the revenue. For example, Vogue Australia sells 12-month subscriptions to its seasonal magazine. On the 1st of January, they received $2,400 for the 50 subscriptions. As of 31st of January, the company has already earned 1 month of revenue, supposing that Vogue prepares financial statements at the end of each month. This will equals to $200. Therefore, the adjusting journal entry should be made on the 31st of January, as the accounting system does not reflect the earned revenue in the general journal. The adjusting entry will mean that it will equal to debit unearned subscription revenue $200 and credit subscription revenue of $200. As Vogue provides the service, liability account will decrease and relative revenue account will increase. Accrued revenue is where the cash is received after the revenue. For example, Vogue Australia agrees to provide access to the online magazine to Miranda Kerr for $50. Vogue gives her full access on the 23rd of March, bills her on the 10th of April, but only receives the payment on the 21st of April. So when will $50 be recorded? 31st of March. Under the accrual basis, it is required that revenues be recorded in a period which they are earned. Therefore, that would mean when Miranda Kerr pays on 21st of April, there will be no revenue recorded, as it would have been recorded prior when earned. Now on to deferred expense. This is where cash is paid before an expense. A company pays for a resource before it uses it or consume it, meaning it will be recorded as an expense instead of recording it as an asset. The adjusted journal entry will always be a reduction in the asset account as the company continues to consume it and increase the expense account. Lastly, accrued expense. This is where cash is paid after the expense, basically meaning it is a liability. The adjusted journal entry for this scenario will always be an increase to a liability account and increase in the expense account. Thank you for listening.
Created using Powtoon.